Okay, let's unpack this. Ethereum just exploded, smashing through its previous all-time high. If you've been watching the crypto markets, you've probably felt that electrifying buzz, that sense of genuine excitement. But what truly ignited this latest surge? Was it just fleeting market hype, a sudden burst of retail frenzy, or was there something much deeper, much more structural at play in the global financial landscape?
Indeed. Yeah, today we're taking a deep dive into the fascinating and, well, increasingly intricate interplay between global macroeconomic signals and the crypto market. Specifically, we're focusing on Ethereum's recent, truly historic performance. Our mission, really for you, is to peel back the layers and understand the core catalysts that powered this rally, and to uncover the institutional undercurrents that are, let's face it, reshaping this space, and to discern what this all could fundamentally mean for Ethereum's trajectory in the months and years ahead. We've sifted through quite a stack of sources, from the financial gravitas of the Wall Street Journal and Investopedia to the crypto-native insights of Cointelegraph and Crypto Briefing to bring you the clearest, most distilled picture possible.
Absolutely. And whether you're new to crypto and just trying to get a handle on what's driving these massive moves, or maybe prepping for a critical meeting where you need to sound truly informed, or maybe you're just insanely curious about what's moving these digital assets, well, we're going to give you the shortcut to being well informed. Get ready for some genuine aha moments, because what we're about to uncover will show you just how deeply intertwined the traditional financial world is becoming with the cutting edge digital one. This isn't just about digital currencies anymore, is it? It feels like it's about a fundamental reevaluation of value in a rapidly changing economy.
That's a great way to put it. It really is a paradigm shift we're witnessing.
So let's begin at the genesis, right? The single spark that truly lit this fuse. And surprisingly, it didn't originate within the crypto sphere itself, but from the very heart of global finance. Echoing out from the highly anticipated Jackson Hole Economics Symposium, we're talking about Fed Chair Jerome Powell's pivotal speech. Now, for anyone who might not be deep in the weeds of macroeconomic news, this wasn't just another public address, was it? It felt different.
No, not at all. It was seen as a critical turning point, subtly signaling a potential easing of monetary policy, perhaps even as early as September. And this significant shift was immediately flagged by leading financial publications like, the Wall Street Journal, the Times of India, along with specialized crypto news outlets such as Cointelegraph and Crypto Briefing. Everyone was highlighting its potential impact.
Right, because the language used is always so careful, so deliberate.
Precisely. What Powell communicated was a distinctly dovish tone. Now, to understand this, let's just briefly unpack that central bank terminology. It's important. The Federal Reserve, like most major central banks, operates with a dual mandate: maximize sustainable employment and maintain price stability, basically, control inflation. When we describe a central bank as dovish, it means their stance favors stimulating economic growth, typically by lowering interest rates or indicating that rates will remain low for an extended period.
Which makes borrowing cheaper, encourages spending, boosts asset prices usually.
Exactly. It's the opposite of a hawkish stance where the priority is fighting inflation, often by raising interest rates to cool down an overheating economy. So when Powell hinted at potential rate cuts on the horizon, it signaled a really significant shift in the Fed's immediate priorities, a shift towards supporting growth and easing financial conditions.
And the why behind the market's instantaneous and frankly strong reaction is absolutely crucial here. Why does a central bank signal like this, often conveyed with very careful, almost coded language, send such profound ripples across every single market? From traditional stocks and bonds to, well, the most volatile digital assets? It feels almost disproportionate sometimes.
It really does, but it connects directly to the fundamental concept of the cost of capital and really the entire psychology of investment.
Yeah.
Interest rates are essentially the price of money, right? The cost of borrowing for businesses and consumers and the return you get on safe assets like government bonds. So when rates are high, borrowing becomes expensive. That naturally slows down business expansion, reduces consumer spending.
And makes riskier investments look less appealing.
Exactly. Why take the risk when the safe return on cash or bonds is attractive enough? But conversely, when rates are expected to fall, the cost of capital goes down across the board. This makes it cheaper for companies to borrow and invest in growth, encourages consumers to spend rather than save. And most critically for our discussion today, it makes risk-on assets, those assets that thrive on growth, innovation, even speculation, far more appealing to investors. It fundamentally influences all investment decisions, recalibrates risk models, and significantly impacts overall investor sentiment. It pushes capital towards growth opportunities.
Okay, so if we extrapolate from this then, what are the broader, maybe even global implications of a potential September rate cut by the Fed? It's not just about the U.S. market then, is it?
Oh, not at all. And this is where that global interconnectedness really comes into play. A potential September rate cut by the U.S. Federal Reserve sends a powerfully clear signal across the world. Other central banks, particularly those in developed and emerging economies, they often closely watch the Fed's moves. They almost have to. A dovish turn from the central bank of the world's largest economy can significantly influence their own monetary policy decisions.
Like a domino effect.
Kind of, yeah.
Yeah.
It could lead to a cascading effect where other central banks might also consider easing their policies, maybe delaying planned rate hikes, or even initiating their own cuts to remain competitive or stimulate their local economies. This synchronicity, this sort of global easing, directly influences international capital flows. It encourages investors to seek out higher returns in growth-oriented assets worldwide as the general cost of money decreases and the pursuit of yield becomes more pronounced across major economies. It can even impact currency valuations, making capital more fluid, always seeking out the most fertile ground for returns.
It's like watching a set of financial dominoes fall, isn't it? And we've certainly seen this playbook before, haven't we? The market's reaction to Powell's speech wasn't just a unique one-off event. It starkly highlights how incredibly sensitive risk assets are to these subtle yet profound shifts in monetary policy.
Absolutely, it's a recurring pattern. We've witnessed remarkably similar market reactions to both dovish and hawkish shifts in central bank policy throughout history. Each time a major central bank signals a significant change in its monetary policy trajectory, whether it's tightening or easing risk assets, and increasingly cryptocurrencies tend to respond. They respond with heightened volatility and often substantial price movements. This happens because investors are constantly recalibrating their portfolios, adjusting their risk exposure, and reevaluating the relative attractiveness of different asset classes based on the perceived future cost of capital and the global economic outlook. It's a clear, almost textbook illustration of how macroeconomic policy emanating from just a single speech can be an immensely powerful determinant of market behavior across the globe.
And the immediate market response was indeed undeniable. Following Powell's, subtle hints, we observed a measurable weakening of the U.S. dollar against other major currencies. Simultaneously, traditional macro assets, stocks, commodities, even some emerging market bonds rallied significantly. And what did crypto do? As a quintessential risk-on asset class, it quickly followed suit, demonstrating its sensitivity to global liquidity. This rapid shift was a headline across Investopedia, The Economic Times, Cointelegraph, The Wall Street Journal, Barron's. They were all reporting on this synchronized market movement.
What's truly fascinating here is the speed and magnitude with which market sentiment shifted, almost in real time. There's a well-established inverse relationship between a weakening dollar and the attractiveness of risk assets, especially those assets priced in dollars, like, many cryptocurrencies. Let me explain that a bit. When the dollar is strong, investors might prefer to hold dollar-denominated safe haven assets. Their purchasing power is higher, they offer a stable return in a volatile global environment. However, when the dollar weakens, those non-yielding growth-oriented assets, particularly those not intrinsically tied to a specific fiat currency, become much more appealing.
They look cheaper, in a way.
Exactly. They appear more valuable when priced in a depreciating dollar, effectively increasing their nominal value. And critically, lower interest rates simultaneously reduce the opportunity cost of holding assets that don't pay traditional interest or dividends. It's a powerful 1-2 punch for risk assets.
So it's almost intuitive once you connect those dots. It's like a fundamental reweighting of the global investment landscape.
It is, once you grasp the underlying mechanics. Think of it like this, using a classic analogy. Imagine a rising tide lifting all boats. When a wave of liquidity enters the financial system, driven by lower rates and a weakening dollar, it lifts various asset classes, including those that were previously struggling or seen as too risky. Or maybe consider it through the lens of international capital flows. A weaker dollar makes foreign goods more expensive for Americans, but conversely, it makes American goods, services, and assets cheaper and more attractive for foreign investors. This fundamental shift in relative value and purchasing power can encourage significant foreign capital to flow into U.S.-denominated assets, including tech stocks, commodities, and, yes, crypto. This global rebalancing of capital seeking higher returns and cheaper entry points significantly impacts valuations across the board, providing a direct boost to growth-oriented assets like Ethereum.
And this powerful macroeconomic spark directly ignited Ethereum. I mean, we saw ETH surge approximately 14–15% shortly after those decisive Fed signals, absolutely smashing through its previous all-time high with incredible force. It hit a closing price near what was at $4,845, with an intraday peak around $4,882. This wasn't just a minor blip on the radar, it was a historic moment, a truly emphatic statement from the market. Widely reported by leading financial news outlets like the Wall Street Journal and CoinDesk, alongside crypto-specific analysis from Crypto Briefing and Yahoo Finance.
The magnitude of this move is truly significant, and it's important to put it into context. A 14–15% surge in such a compressed time frame for an asset of Ethereum's substantial market capitalization, which is, in the hundreds of billions of dollars, is not something you witness every day. For a sense of scale, achieving even a 1% or 2% gain in a single day in traditional stock markets is often considered a strong performance for a well-established large-cap company.
Yeah, 15% move is massive.
It represents a massive sustained inflow of capital and a very strong collective buying conviction. It emphatically signals that this wasn't merely a small bump in an otherwise flat market, but a substantial, decisive, and fundamentally driven move powered by deep forces. It's the kind of surge that, frankly, redefines market expectations.
It really does put it into perspective, highlighting the intensity of this rally in the crypto space. But what's even more compelling and perhaps more indicative of a shifting landscape is how Ethereum didn't just rally. It significantly outperformed Bitcoin during this period. Year to date, Ethereum has gained approximately 45%, while Bitcoin, the original crypto king, saw about a 25% gain over the same period. That's a big difference. This stark divergence has naturally led to significant speculation and discussion about its evolving position, with some now asking if Ethereum is becoming Wall Street's preferred blockchain. These compelling performance numbers have been highlighted by financial analysts and reported across Investopedia, the Wall Street Journal, and Mitrade.
Right, and this is where we get to a crucial aha moment, I think.
Right.
If we connect this to the bigger picture, why might Ethereum be outperforming Bitcoin so dramatically in this specific macroeconomic environment? Bitcoin has largely cemented its narrative as digital gold, right? A store of value, a hedge against inflation, increasingly a macro asset akin to a digital commodity. Its value proposition is relatively straightforward, primarily focusing on scarcity and decentralization. Ethereum, however, is a profoundly different beast. It's not just a digital asset, it's a programmable blockchain, a foundational layer for an entirely new digital economy.
The world computer idea.
Exactly. It's the backbone for what we call DeFi, or decentralized finance. Imagine a parallel financial system where you can lend, borrow, trade, earn yield without traditional banks or intermediaries, all powered by transparent code and smart contracts. And then there are NFTs, non-fungible tokens, these unique digital assets like digital art, collectibles, even virtual land, with ownership securely recorded and verified on the blockchain. Institutions looking for growth, for innovation, for utility beyond just a store of value might increasingly find Ethereum's versatile platform capabilities and its vast ecosystem of applications far more appealing. They're looking for a digital asset they can not just hold, but build on, participate in, and integrate into a dynamic, future-proof financial strategy.
So when we hear the phrase Wall Street preferred, it's not just about a simple preference, is it? It implies something much more strategic and long-term.
Exactly. It suggests a deeper conviction and a more strategic outlook that moves beyond speculative trading. It implies that traditional financial institutions, asset managers, large investors are increasingly recognizing the profound direct growth potential and the wider array of use cases inherent in Ethereum's ecosystem. They're looking at its programmable nature, its ability to host complex financial applications, its ongoing technological advancements like the upcoming upgrades, and its robust developer community as powerful long-term value drivers. While Bitcoin remains foundational, offering digital scarcity, it doesn't offer the same level of direct utility and innovation potential as a platform.
That's a critical distinction.
It is. And this distinction can make Ethereum a significantly more attractive investment for institutions seeking exposure to the cutting edge of digital asset development and the future of finance. It's a recognition of its role as an economic operating system, not just a digital commodity.
This raises an important and, somewhat provocative question for the future. Is this outperformance we're seeing in Ethereum merely a temporary trend, perhaps just a cyclical shift in investor preference within a broader bull market? Or, and this is the bigger implication, does it signal a more fundamental structural shift in institutional preference towards utility-driven, programmable blockchains like Ethereum, suggesting a long-term recalibration of value in the digital asset space? It's a question with enormous implications for the long-term outlook of the entire crypto market.
It absolutely is the defining question right now. Historically, we have indeed observed periods where altcoins, including Ethereum, significantly outperform Bitcoin, often during phases of heightened risk appetite or specific technological advancement within their respective ecosystems. However, the current narrative, which is strongly supported by the increasing institutional inflows and strategic treasury accumulation we'll discuss shortly, suggests it could be more than just a fleeting trend. The underlying utility of Ethereum, coupled with its continuous evolution through significant upgrades, and the increasing sophistication of institutional investors who are now looking beyond mere speculation, might very well be pointing towards a more enduring structural shift. The stark 45% versus 25% year-to-date performance isn't just a statistic. It's a tangible, undeniable example of this divergence in perceived value and growth potential, a difference that large institutions are certainly noticing and, well, acting upon. This kind of sustained outperformance usually indicates a deeper conviction.
Okay, so beyond the powerful macroeconomic shifts and Ethereum's impressive outperformance, there are deeper, more sustained currents driving this rally. Specifically, a significant growing increase in institutional demand and, well, truly strategic accumulation. We're seeing renewed ETF inflows and broader institutional interest now identified as durable tailwinds, providing solid support for Ethereum's price, according to analysis from FX Street and DL News.
That's right, and it's a critical distinction. When we talk about ETF inflows, we're referring to exchange-traded funds. These are investment vehicles designed to hold underlying assets, stocks, bonds, commodities, or, in this case, cryptocurrencies. Inflows means that investors, particularly large institutional ones, are actively putting more money into these funds. The ETFs then use that capital to purchase the underlying assets, in this scenario, Ethereum. For large financial players, think pension funds, asset managers, hedge funds, ETFs represent a more regulated, familiar, and crucially, an accessible pathway to gain exposure to crypto.
It sort of simplifies things for them, right? Avoids the custody headaches.
Precisely. It bypasses the complexities of direct digital asset custody, security, regulatory compliance, making it a much more palatable and efficient bridge between traditional finance and the crypto world. These inflows signify serious capital deployment.
And the term durable tailwinds is particularly interesting here. Why is institutional investment considered a durable tailwind, something that suggests long-term support, rather than, say, a fleeting trend driven by short-term retail speculation?
A durable tailwind is exactly what it sounds like, a sustained, powerful force that consistently supports growth over an extended period. Institutional investment implies a level of deep conviction, rigorous due diligence, and a strategic, often multi-year allocation of capital. That's fundamentally different from retail speculation. Unlike individual retail investors whose decisions can often be more volatile and driven by short-term sentiment or news cycles, institutional money tends to be stickier. It's deployed after extensive research, involves board approvals, often has long-term mandates.
So it's not just jumping in and out.
Not typically, no. This signals a deeper, more integrated acceptance of digital assets into traditional financial portfolios. It suggests these large players view Ethereum not as a passing fad or a high-risk gamble, but as a legitimate and growing asset class, thereby providing a more stable and consistent foundation for its price appreciation. If you contrast this with earlier crypto cycles, which were overwhelmingly fueled by individual retail investors taking on higher risks, the current institutional involvement signals a significant maturation of the market and a more robust foundation for future growth. It's a systemic shift.
It's not just about institutions buying through ETFs, though. We're also witnessing what's being termed treasury accumulation. Notable entities like ETHZilla and Bitmine Immersion are actively accumulating millions of ETH for treasury use. This echoes similar themes from the 2021 bull run, but, and this is key, with a more substantive strategic positioning. This nuanced shift was highlighted in recent reports from FX Street and DL News.
Yes, treasury use in this context means that corporations, large organizations, maybe even sovereign wealth funds, are holding digital assets like Ethereum directly on their balance sheets. This isn't simply for speculative trading, it's a strategic corporate decision. It can be for long-term investment, maybe as a hedge against currency devaluation or inflation, or increasingly for operational purposes directly within the burgeoning crypto ecosystem. This might include using ETH to facilitate decentralized applications, participating in staking to secure the network and earn yield, or powering their own blockchain-related initiatives and product development.
So it's more integrated.
Exactly. The shift to substantive strategic positioning is incredibly critical. In 2021, some corporate treasury moves into crypto might have been perceived as more experimental, maybe opportunistic, or even a marketing play. Now, it signifies a much more deliberate, integrated, and genuinely long-term approach. These companies aren't just buying, they're explicitly building their future foundations and integrating their core operations around Ethereum as a core digital asset. They are looking to leverage its utility directly.
That's a profound distinction. So how might this trend of corporate treasury accumulation accelerate if more corporations begin to adopt crypto as a treasury asset? And what are the broader implications for Ethereum's supply dynamics, especially if this continues at scale?
Well, if more corporations follow this lead and strategically integrate Ethereum into their treasuries, we could see a significant acceleration of this trend. It could create a powerful network effect. Each new corporate adoption validates the asset class further, potentially encouraging a ripple effect among competitors or within their supply chains. From a supply dynamic perspective, this creates a truly fascinating and potentially explosive scenario. When companies hold substantial amounts of ETH in their treasuries for strategic, long-term use, effectively moving it off exchanges and into long-term custody, that supply is taken out of immediate circulation.
So less ETH available to buy on the open market.
Precisely. It's no longer readily available for active trading on liquid exchanges. This reduced liquid supply, combined with increasing demand from institutions, developers, and retail investors, could exert immense upward pressure on Ethereum's price over time, particularly if this accumulation continues at a substantial and growing pace. It could lead to a genuine supply crunch down the line.
Okay, here's where it gets really interesting, I think, and we can start to see patterns emerging. This current rally isn't entirely unprecedented. If we look back, we can draw compelling comparisons between Ethereum's current bullish cycle and previous ones, like the electrifying 2020-21 DeFi boom. In those periods, distinct shifts in interest rates or global liquidity often led to significant altcoin surges and pronounced outperformance over Bitcoin. Similarly, past discussions or actual approvals of ETFs for cryptocurrencies sparked similar price run-ups. This crucial historical context from DL News really helps us understand the current moment.
Indeed. This is why understanding historical cycles is so vital. Macroeconomic shifts, particularly those involving substantial liquidity injections into the financial system or significant changes in interest rates, have consistently acted as powerful catalysts for altcoins. Let's rewind to the 2020-21 bull run, often dubbed DeFi summer and beyond. That period was fueled by unprecedented global liquidity, a veritable flood of easy money from central banks responding to economic shocks. And what happened? Ethereum, as the indispensable engine for almost all decentralized applications, became the undeniable epicenter.
Everything ran on ETH, basically.
Pretty much. We saw total value locked, TVL, in DeFi protocols skyrocket from under $1 billion to well over $100 billion. It was incredible growth. Projects like Aave, Uniswap, Compound became household names for crypto enthusiasts, enabling lending, borrowing, swapping of digital assets. Every single transaction, every smart contract interaction required ETH to pay for gas fees. It was a tangible, real-world demonstration of utility meeting overwhelming market demand, all amplified by accommodating global monetary policies.
And the conversation around ETFs mirrors that in some ways too, right? The anticipation itself moves markets.
Exactly. Remember the intense speculation and subsequent price rallies we saw around the first Bitcoin futures ETF, and then the even more impactful spot Bitcoin ETFs. Even the prospect of these traditional financial products making crypto more accessible to a vast pool of institutional and retail capital generated powerful upward momentum. It created a buy-the-rumor environment that fundamentally altered market dynamics. It's clear these macroeconomic tailwinds, this easy money, and these institutional on-ramps through regulated products aren't new phenomena in crypto. They are recurring patterns that fundamentally shape crypto market cycles, and Ethereum is now very much at the forefront of benefiting from them. This historical lens tells us that these aren't random events, but rather predictable responses to shifts in the broader financial climate and regulatory landscape.
Okay, so beyond the powerful macro and institutional drivers, the technical analysis of Ethereum's price chart also tells a truly compelling, almost dramatic story. Analysts have observed what they're calling a God candle breakout. That's quite a term, where Ethereum's price surged definitively and powerfully above key resistance levels. This breakout, in turn, formed classic bullish pennant patterns, which are considered incredibly strong indicators in technical analysis. We saw this reported across the Wall Street Journal, Cointelegraph, and the Times of India.
A God candle is indeed a visually dramatic and highly significant term in technical analysis. and it speaks volumes. It refers to a very large single candlestick on a price chart that shows a rapid, aggressive, and highly significant upward price movement. It's characterized by its much longer body compared to preceding candles, indicating immense, sustained buying pressure that often breaks through strong, long-standing resistance levels with undeniable conviction. When you see a God candle print on a chart, it usually signifies a decisive shift in market sentiment, a rapid absorption of supply, and a powerful impetus for continued upward movement.
Like a statement of intent from the buyers.
Exactly. I recall watching a particular altcoin chart during the last bull run,
Huh?
and this massive green candle printed. It was so dramatic, so out of character for that asset's recent history, that it instantly shifted the mood from cautious optimism to outright FOMO. It felt like watching a financial dam break in real time, unleashing a torrent of buying.
Wow. And these bullish pennant patterns, what do those signify for someone who might not be intimately familiar with chart reading?
Think of a bullish pennant pattern like a compressed spring after a powerful initial jump. The pole of the pennant is that dramatic, rapid price surge, that God candle movement signaling extremely strong buying conviction and a clear upward trend. Following this initial burst, the price then briefly consolidates. It forms a small symmetrical triangle shaped the pennant itself as buying and selling pressure temporarily balance out, and the market takes a short breather. Crucially, this consolidation phase is usually quite brief, and it indicates a pause before another strong move in the same direction as the initial surge.
So it's like catching its breath before the next leg up.
Precisely. A bullish pennant is considered a continuation pattern. It suggests that after this temporary consolidation, the price is highly likely to break out upwards again, continuing its previous trend with renewed momentum. Visually, imagine that dramatic vertical climb followed by a brief, tight sideways movement as the market gathers its energy, and then another potential upward burst. That's precisely what technical analysts are observing on Ethereum's charts right now, signaling more potential upside.
Okay, so based on these very strong, almost textbook bullish technical signals, analysts have actually set ambitious price targets for Ethereum, with some projecting figures up to $6,000, provided, of course, that the current momentum holds. This target has been widely discussed and mentioned across various leading financial and crypto sources, including the Wall Street Journal, Cointelegraph, the Times of India, and FX Street.
Yet these price targets, like the $6,000 mark, they're not simply pulled out of thin air. They are systematically derived from technical analysis methods that extrapolate patterns and measure the potential breakout magnitude from formations like the bullish pennant. Analysts might use techniques like measured moves, where they project the length of the initial pull of the pennant from its breakout point. Or they might utilize Fibonacci extensions to identify potential resistance levels and future targets. It's a calculated projection based on historical price behavior and current chart dynamics, providing a roadmap for potential future movements.
But with a big if.
Absolutely. It is crucial to emphasize the caveat here. If momentum holds, this is not a guarantee. It is a projection based on the continuation of current market dynamics, sustained buying pressure, and positive sentiment. Any significant shift in the macroeconomic landscape or, a loss of buying conviction could, of course, alter this trajectory.
So, what does this all mean for you, the listener, especially if you're looking at Ethereum and considering its future trajectory? A $6,000 target isn't just an arbitrary number. It implies significant further growth, a substantial upside from its current all-time high. This kind of projection could fundamentally change investment strategies for many, prompting them to reevaluate their current positions, consider new allocations, or adjust their long-term outlook.
Precisely. For an investor, a target like $6,000, which represents a substantial percentage gain from current levels, could trigger a reevaluation of everything from risk tolerance and portfolio diversification to long-term holding versus shorter-term trading strategies. It suggests a potential for continued robust appreciation, which can be highly attractive in a low-yield environment. It forces a recalibration of what constitutes conservative versus aggressive allocation within a digital asset portfolio.
And it's not just about interpreting price charts and technical patterns. On-chain data also seems to be corroborating these bullish signals, adding another layer of conviction. Specifically, on-chain data reveals that the overall Ethereum supply held on centralized exchanges is currently at multi-year lows. This particular trend typically implies accumulation rather than distribution, as Cointelegraph emphatically reported.
Yes. This metric, the supply of Ethereum available on exchanges, is incredibly crucial for understanding real-time market sentiment and potential future price movements. When the supply of ETH on exchanges is low, it directly suggests that fewer Ethereum tokens are immediately available for sale to the broader market. This indicates that holders are actively moving their assets off exchanges, likely to cold storage for long-term holding, maybe to staking protocols to earn yield and secure the network, or into various decentralized finance DeFi applications where the tokens are locked up.
They're HO dealing, basically, or using it.
Exactly. This action is a strong, undeniable signal of accumulation, where a significant portion of the market is buying and holding for the long term rather than distribution, which would imply selling or actively preparing to sell. To use a simple analogy, imagine a popular item in the store suddenly running extremely low on stock. It signals very high demand, and that people are eagerly taking it off the shelves, not bringing more in to sell. It reinforces the idea that conviction among Ethereum holders is incredibly strong, and they are not looking to liquidate their holdings anytime soon. This scarcity, combined with rising demand, is a powerful bullish force.
Okay, so we've navigated through the macroeconomic spark, detailed Ethereum's record-breaking ascent and outperformance, explored the growing institutional and treasury demand, and dissected the compelling bullish technical signals. All of this, taken together, paints a vivid picture and points to a larger narrative. Ethereum's robust performance signifies a renewed bull phase for the asset itself, and potentially a powerful catalyst for broader altcoin cycles. This was a key takeaway from insights published by DL News.
That's a critical and far-reaching observation. Given Ethereum's sheer size, its central role as the dominant smart contract platform, and its indispensable position in the entire decentralized ecosystem, it is very often seen as a bellwether for the entire altcoin market. Its robust performance and the powerful forces driving it can indeed create a significant ripple effect across the broader crypto landscape. When Ethereum rallies strongly and sustains that momentum, it tends to instill a deep sense of confidence across the entire altcoin space.
Kind of lifts the whole market's mood.
It really does. This confidence often leads to capital flowing not just into ETH, but also from Bitcoin and into other altcoins, a phenomenon often referred to as alt season. This is because once Bitcoin has made its initial strong moves and established a certain market tone, investors typically look for higher risk, higher reward opportunities further down the market capitalization ladder, seeking amplified gains in more nascent projects that leverage Ethereum's infrastructure.
So, if this truly is a renewed bull phase for Ethereum, what implications does it have for the entire crypto ecosystem, not just for ETH itself? We could potentially see a significant ripple effect across various sectors, couldn't we? Like DeFi, NFTs?
Absolutely. The implications are profound and pervasive. A sustained bull phase for Ethereum would almost certainly invigorate the entire ecosystem. We could see significantly increased activity, development, and investment in DeFi protocols, as more ETH means more capital available for lending, borrowing, trading, providing liquidity, driving innovation in decentralized financial services. The NFT market, which primarily lives on Ethereum, could also experience a major resurgence, with renewed interest in digital collectibles, art, and gaming. Furthermore, other Layer 1 blockchains, which often compete with or complement Ethereum, might also benefit indirectly from increased investor retention and capital flows, as the general optimism and confidence for the entire digital asset space grows.
It's like a positive feedback loop.
Exactly. Ethereum's success acts as a tide that lifts many other boats in the crypto ocean, fostering growth across various sectors from gaming to supply chain to decentralized social media.
And bringing it back to that crucial macro picture, those anticipated rate cuts are fundamentally lowering the opportunity cost of holding non-yielding assets like crypto. Simultaneously, a weakening US dollar simply supports crypto valuations by making them appear relatively cheaper. This powerful compounding dual effect was strongly emphasized in analyses from Barron's and Investopedia.
This opportunity cost concept is absolutely vital to grasp. Let's put it in a very simple, relatable context. Imagine you have $100. If a very safe savings account or a government bond is offering you a guaranteed 5% return, that's a pretty good no-risk option for your money. But if you choose to put that same $100 into Ethereum, which, unlike a bond, doesn't pay a fixed interest or dividend, you are effectively giving up that safe 5% return. That's the cost of your choice, the opportunity cost.
What you could have earned safely.
Exactly. Now, if the Fed cuts rates and that safe savings account suddenly only offers a meager 0.5%, the cost of putting your money into a potentially high-growth, non-yielding asset like Ethereum is dramatically lower. That small 0.5% isn't nearly as enticing to give up, making Ethereum with its potential for much larger gains comparatively far more attractive. It fundamentally rebalances the entire risk-reward equation for investors, shifting the incentive structure.
So it's really the powerful combination of those two factors that creates such a strong tailwind for crypto. Lowered opportunity cost and a weaker dollar.
Exactly. The dual effect is what makes this macro backdrop so incredibly potent. Lower interest rates make non-yielding crypto assets inherently more attractive because the alternative, holding cash or traditional low-risk bonds, is significantly less rewarding. Concurrently, a weakening U.S. dollar effectively boosts the relative value of assets priced in dollars, like many cryptocurrencies. It's like a financial seesaw. As the appeal of traditional interest-bearing assets goes down due to lower rates, the perceived value and attractiveness of non-yielding growth-oriented assets like crypto go up. This creates a strong systemic tailwind that can significantly propel their valuations, drawing capital away from traditional safe havens and into riskier but potentially much more rewarding digital assets.
Now, this all sounds incredibly bullish, and the evidence we've laid out certainly points to a strong, compelling case for Ethereum's recent surge and potential continued growth. However, there's always a crucial question that sophisticated investors must ask. Is this breakout sustainable in the long term? Or is it merely a macro-triggered pump, a temporary euphoria that could lose steam if the Fed changes its tune or if global conditions shift once more?
This is indeed the core debate that investors, analysts, and economists are grappling with right now, and it embodies the dynamic interplay of fundamental and external factors. On one side, you have those who view the increasing institutional adoption, the strategic corporate treasury accumulation, and Ethereum's fundamental utility as a platform for continuous innovation as powerful indicators of a structural long-term shift. They argue these are durable trends that will continue to drive growth regardless of short-term macro fluctuations, embedding Ethereum deeper into the global financial infrastructure.
The "it's different this time" argument, partly based on real structural changes.
Right. But on the other side, there's the equally valid perspective that this rally is primarily, if not exclusively, driven by external macroeconomic factors. Specifically, the anticipation of Fed rate cuts and the search for yield in a low interest rate environment. This view suggests that if the Fed stance were to unexpectedly pivot, maybe inflation picks up again, or if global economic conditions deteriorated, then this macro-triggered pump could indeed lose momentum, leading to a significant correction. Both arguments hold weight, and the truth likely lies in a complex combination of the two.
It's a dynamic interplay, and it really forces us and you, the listener, to engage in critical thinking, to weigh the evidence. We've laid out the various layers of evidence today, the institutional moves, the compelling technical indicators, and that powerful macro backdrop. But the ultimate interpretation and your strategic response is, of course, entirely up to you. So do you think Ethereum's breakout is fundamentally sustainable, reflecting a deeper shift in value? Or is this just a powerful macro-triggered pump that could lose steam if the Fed changes its tune, perhaps sooner than expected?
And following that thought, if Powell is indeed paving the way for sustained rate cuts and a looser monetary environment, would you consider shifting more of your allocation from Bitcoin, often seen as digital gold, to Ethereum, the digital operating system, in your own portfolio? Are you betting on its utility? Or from another angle, what do you truly think is stacking ETH for the long term right now? Are we talking primarily about these treasury whales and sophisticated institutional players, or is this primarily driven by retail investors looking for robust DeFi yield and other ecosystem opportunities? It's all about how you interpret these complex signals.
It truly is all about weighing the evidence, understanding the underlying forces, and considering the possibilities for what comes next. Hashtag tag outro. So what does this all mean? We've seen Ethereum hit a fresh all-time high driven by a powerful multifaceted combination. You've got dovish signals from the Federal Reserve, significant and strategically motivated institutional and corporate treasury demand, and strong, unambiguous bullish technical indicators. It's a truly fascinating look at how global macrofinance directly impacts the crypto world, creating these electrifying moments and, well, reshaping the landscape of digital assets.
Ultimately, we've explored the robust evidence suggesting a renewed bull phase and perhaps even a fundamental structural shift in how Wall Street and corporations are now viewing Ethereum. Moving beyond mere speculation to recognizing its profound utility and growth potential. But as with all market movements, especially in this nascent and dynamic space, the question isn't just what happened, but what happens next. If that ambitious $6,000 target comes into play or even gets surpassed, would a breakout to $6,000 fundamentally change your long-term strategy for digital assets? Or is that still perhaps wishful thinking given the inherent macro uncertainties that always loom? It's a powerful thought to consider as you digest today's deep dive.
Absolutely. And this deep dive was designed to give you unparalleled clarity and essential context on one of the biggest, most exciting stories in crypto right now. If you're fired up by Ethereum's fresh high, or if these timely breakdowns and unique insights resonate with you, please do us a huge favor. Don't forget to like this video, subscribe to our channel, and definitely hit that notification bell. Your engagement, every like, every comment, every subscription truly helps us support the channel. It boosts our visibility in the ever-important algorithm and genuinely allows us to keep creating this kind of quality, in-depth crypto content just for you, helping more curious minds navigate this incredible wave of innovation. Thank you for diving deep with us.